Okay, so let's look at the example we just went through for accounts receivable and try to do similar things for some of the most common working capital line items that you're going to encounter on the job. And that's certainly some of which we're about to encounter with Apple. So here, I'd like you to take a moment and fill in the blanks based on your own understanding of the relationship between income statement forecasts and the impact on the balance sheet item. So I gave you the first example I'd already sort of provided. And I said, hey, you know what? For accounts receivable, how are we going to grow this? Another term for this is, what is the driver? What is the sort of forecast driver for accounts receivable? And as we talked about, well, it's, the revenue growth rate. And again, just to I guess for those that are relatively new to kind of even thinking about this and are kind of new to accounting, I mean, think about it this way if this isn't clear. Imagine you've got a lemonade stand, the simplest sort of analogy with accounting, and you generate, let's kind of say you generate revenue in the last historical year. So let's say 2020, that was the last historical year, you generated revenue of 100. Let's kind of get this right. And, you collected during that year, by the end of the year, there was accounts receivable. You were waiting to collect $10 of that $100 in revenue, right? So by the end of the year, you had put $90 in cash in your pocket and you're still waiting on 10. Well, if you're forecasting next year, say this is 2021, and you're forecasting revenue of 120 because presumably you went to equity research or you did your own analysis and you're forecasting revenue growth of 20%. Well, what do you think you're going to kick out at the end of the year with AR? Assuming no thesis on sort of I'm going to get more aggressive about collection or I'm going to get less aggressive, well, I would just sort of assume the same rate of growth, right? So for every dollar of revenue, you actually have 10 cents of accounts receivable recognized. And it's the same idea here. So this is the point. If you grow accounts receivable with the revenue growth rate, this is the conceptual framework that you're using. And I want you to think about each one of these line items in the same way. So think about inventory. If I'm saying that on my income statement, I've got these projections for revenue and expenses in a certain way, can you think of the most direct driver for inventory that you may have already thought about? Prepaid expenses. Now, one thing, again, for those that are relatively new to accounting, reminder here, prepaid expenses reflect prepayments for utilities, things like rent, insurance, things that you pay upfront as a business, sometimes wages, like a bonus, for example. Since these expenses are not recognized, this is sort of the accrual principle of accounting. If you prepay for a year's worth of utilities, you're not going to recognize that expense in SG&A until you actually use those utilities, right? That's the matching principle at play. That's the accrual concept at play. And therefore, when you prepay up front, right, cash goes down. Let's say you paid $1,000 for some 12 months of utilities. So you're going to have cash go down. Let's say it costs you $1,000. Cash is going to go down by $1,000. That's a credit, right? And then the offsetting entry is not an expense on the income statement, like it would be if you were actually paying for something that you're using during the current period. But instead, an asset goes up, a prepaid asset goes up by that $1,000, and then eventually it'll cycle out of this asset. This asset will go down, and the offsetting entry will eventually become within retained earnings as an expense within SG&A or what have you. All right, now on the other side, accounts payable, I suspect most are familiar with that, just like I assume that you're familiar with inventory. But let's scroll down to something that you may be a little less familiar with, and that is the concept of deferred revenue. This reflects revenue received by the company that hasn't yet been earned by the company, and thus it can't be recognized as revenue quite yet. So an example of that would be gift cards, right? If Apple were to sell gift cards, then it actually hasn't earned anything yet, so we can't quite recognize revenue for that. So in that case, let's say you sell $1,000 worth of gift cards. So let's kind of do a deferred revenue example up here. You sell gift cards, so cash goes up if you're Apple. Right, let's say you sell $1,000 worth of gift cards. But of course, you can't recognize any revenue yet because the revenue can only be recognized when it is earned. And so the way the GAAP deals with this is instead of what you might sort of think would happen, retained earnings, revenue goes up by 1,000. You can't do that. You can't have the offsetting entry be revenue. We're not going to do that. What instead is going to happen is you're going to have a liability. because now you've got these, and it's called a deferred revenue or an unearned revenue liability, and that's going to go up by 1,000. And the reason why you should think about it as a liability is, you, Apple, have $1,000 worth of product that you have to provide to someone that's just walking around holding this gift card. That is a liability now. You received the cash before, and now you've got to deliver the service in the future. And so this is what deferred revenue represents. Now, interestingly for Apple, and we're going to get to this in a little bit later and kind of walk through some debits and credits in more detail, but Apple, the big driver of Apple's deferred revenue, also called unearned revenue, isn't just gift cards. Actually, a bigger piece of it is these implied software upgrade rights that customers get when they buy an iPhone. So when I buy an iPhone or an iPad or what have you, I pay $1,000, Apple gets that $1,000, but they can't recognize the full $1,000. And the reason why they can't is because baked into that sale is that I, as a customer, have software within that iPhone that I'm going to keep being able to upgrade and improve as their operating systems get better, etc. Apple recognizes a small portion of that $1,000 as these implied as value coming from future implied software upgrade rights. And so, even though let's kind of repurpose this example here, and let's say Apple sold me $1,000 iPhone, I get cash. Apple gets cash of $1,000. They recognize revenue. Let's again repurpose this entirely. So you're going to get revenue within retained earnings of maybe $980 because they did sell you the iPhone. They did earn that revenue, but $20 they've defined as value for future software upgrade rights, which they haven't delivered yet. That becomes a liability that they amortize over 2 years and just sits on the books. So again, these are the, for Apple, that's a particular item. Other companies have it for other things. The main point here is deferred revenue represents revenue received that hasn't yet been earned by the company. All right. Last but not least, we've got two other items that probably are worth mentioning for the accounting newbies. Accrued expenses reflect wages and other expenses that have already been recognized but not yet paid out by the company. So if you think of sort of prepaid expenses as prepaid wages as a hiring bonus, this might be a bonus, a year-end bonus, right? So a year-end bonus, the company that provides an employee a year-end bonus, presumably that employee has been earning that bonus over the last 12 months. And so under GAAP, you have to recognize that bonus as it's earned, not necessarily when you as a company pay it out. And so what ends up happening, let's carve off another little section here. And we've got accrued expenses. So let's say an employee has earned a bonus of $1,000. That hits SG&A, or depending on whatever the expense categories that's relevant within retained earnings. So SG&A, that lowers retained earnings. It's an expense. So let's say you recognize that as $1,000 throughout the year, but of course you haven't paid it out yet. You're going to pay it out at the very end of the year. So as you're sort of accruing this expense, you have to recognize a liability, right? So this is a liability called accrued expense. It goes up the offsetting entry here. And of course, once you pay out the cash, this liability will go away. So that's the logic there. And last but not least, taxes payable. These reflect taxes that are due by a company but remain unpaid. Obviously, when companies operate, they are paying taxes on business that they've done over the last quarter, over the last 12 months, or what have you. And so when that's due, but you haven't paid it yet during that time period, you're going to recognize a tax payable. So at this point, give this a shot. Try to figure out what might be drivers that we've already looked at on the income statement that should be linked to these items, and that's the framework for thinking about this. When you're ready or you think you've given this a shot, let's move on to the next video and I'll walk you through how I think about these forecasts.